Hello and welcome to the financial and non-financial comparison for CSL and Woolworths Limited. So this report is presented in conjunction with the accompanying notes located in the notes page. A bit of background on CSL and Woolworths. CSL Limited is a global biotechnology corporation with headquarters in Australia. The principal focus of this corporation is the development and production of blood plasma derived therapies, vaccines, and other specialty pharmaceuticals. Woolworths Group Limited is one of Australia's leading retailers operating in the grocery, alcohol, and hospitality industries. They also have operations in New Zealand as well. So there's a few things to remember when comparing the financial ratios. One being that CSL Limited operates in the pharmaceutical and biotechnology industry, which generally has high research and development costs and strict regulations. And sometimes this can lead to higher expenses and lower profit margins. However, its focus on specialised medical products can result in higher net profit margins. Woolworths Group operates in the competitive retail sector with thin profit margins due to intense price competition, inventory management costs, and frequent promotions. CSL biotechnology focus may require significant investments in R&D and innovation, potentially yielding higher returns. Woolworths Group, on the other hand, has substantial equity tied up in physical assets, resulting in a lower return on equity. CSL's quick ratio may be lower due to its unique assets, while Woolworths is likely to be higher due to its marketable inventory. So there are differences when comparing companies in different industries, and we have to take that into account during this presentation. So during this presentation, we are going to determine which company has better liquidity options and which company is more profitable based on 3 years of data from 2020 to 2022. So looking at the liquidity data, CSL Limited maintained a current ratio of 2.57% over 3 years. This indicated a strong ability to meet short-term obligations using current assets. The company's current liabilities have grown at an average rate of 91%, with a significant increase in short-term debt from 2021 to 2022. Current assets have also grown, with an average gain of 74% and a significant 143% increase from 2021 to 2022. CSL has managed its short-term liabilities effectively through the use of liquid assets, with a quick asset ratio of 1.37 in 2020 and a substantial cash balance over $2 billion. The company has sustained capacity to fulfill half of its short-term liabilities, with a 38% growth in cash assets and a 32% increase in liabilities. Looking at Woolworths Group, they have maintained a stable current debt to assets ratio for 3 years, with a current ratio of 0.62 in 2020. However, in 2021, the balance sheet increased to $15 billion, counterbalancing the rise in total current liabilities. Despite the COVID-19 pandemic and supply chain disruptions, Woolworths' current ratio remains stable. The company's quick asset ratio was 0.28 in 2020, suggesting challenges in fulfilling short-term obligations. However, in 2022, Woolworths' quick asset ratio declined to its lowest level, and this may be influenced by Endeavour's Group demerger. Woolworths Group's cash asset ratio is also low, indicating it cannot solely rely on cash as a funding source for its debts. In summary, CSL Limited maintained strong liquidity throughout the 3 years with consistently high current and quick asset ratios. Woolworths Group faced challenges in its liquidity, particularly in 2020 and 2022, but its prominent position in the market suggests the ability to raise funds to meet short-term obligations would not be an issue. Looking at the profitability figures for CSL and Woolworths Limited, CSL has consistently shown strong returns on equity, with an average of 26% from 2020 to 2022. The company's net profit after tax before abnormals, which can be called NPAT, growth rate was 6%, with a 70% increase in profits before interest and tax in 2020. The company's total assets increased by 70% between 2021 and 2022, primarily due to increased cash reserves. CSL maintained a 23% profit margin with a 9% increase in revenue in 2020. The company's resilience and adaptability during the COVID-19 outbreak was evident, and it also played a key role during that period. Woolworths Group has consistently performed well over the past 3 financial years, averaging a 23% return on equity, 18.3% in 2020, and a 41.8% growth in online sales during the same period. The company's return on assets remained consistent, with a result of 4.28% ROA in 2020 and 5.7% in 2022. Woolworths Group profit margin remained stable, with a 2.69% average in 2020 and a 2.77% net profit margin in 2022. The company's cash flow to sales remained consistent, with a 7.16% return in 2021. Looking at these figures, in summary, CSL Limited and Woolworths Group both displayed strong profitability over the 3-year period, and it's important to note that they are in different industries with different profit margins and different profitability ratios. Looking purely at the numbers though, CSL had a higher return on equity and a stronger profit margin. Woolworths Group, on the other hand, showed strong stability and growth in return on assets, and these findings suggest that both companies have performed well, but purely based on the numbers, CSL is the more profitable company. Doing a sustainability analysis, the KPMG report for 2022 shows that 97% of ASX 100 index firms disclose sustainability initiatives, and CSL and Woolworths are both companies that participate in sustainability disclosure. So CSL Limited addresses sustainability development issues in its annual reports, while Woolworths Group publishes a separate document. CSL's sustainability strategy focuses on incorporating sustainable principles into business decision-making, prioritising individual well-being and communities, and fostering and investing in innovation. Woolworths aims to foster an inclusive work environment, promote career opportunities, and establish ethical partnerships. The company aims to achieve 100% green electricity usage by 2025 and net positive carbon emissions beyond this timeframe. Woolworths also aims to address hunger and food waste by collaborating with community agencies and enhancing stewardship of natural resources. Given the information and on whether or not one company is more profitable or more liquid than the other, I've made a determination on that, and also a determination on the sustainability and whether or not the company should proceed with sustainability reporting. So, based on the information provided, CSL Limited and Woolworths Group both exhibited commendable financial and non-financial performances over the 3-year period, albeit in different areas. CSL Limited demonstrated exceptional financial performance. The profitability, CSL consistently reported high profitability with an impressive return on equity, averaging 26% over the 3 years, reflecting strong returns to shareholders. The company also maintained a robust profit margin, averaging 23%, and achieved significant cash flow to sales ratios. CSL exhibited strong liquidity with a consistently high current ratio and quick asset ratio. The company effectively managed its short-term liabilities through the utilisation of liquid assets. Sustainability, CSL showcased a comprehensive sustainability strategy, highlighting its commitment to environmental, social and workforce sustainability. The company's financial performance was not only strong, but also complemented by its dedication to sustainability. Woolworths Group exhibited strength in different areas. Woolworths Group displayed a remarkable return on equity, averaging 23% over the 3 years, although there was an exceptional spike in 2021. The company's profit margin remained stable, showcasing financial stability. Woolworths Group faced challenges in liquidity, especially in 2020 and 2022, as indicated by its current and quick asset ratios. However, its prominent market position, as mentioned before, suggests the ability to raise funds to meet short-term obligations would not be an issue. Woolworths Group highlighted its commitment to environmental, social and workforce sustainability by displaying a comprehensive sustainability strategy. So, in summary, given the data presented, CSL Limited's strong financial performance, impressive liquidity management and commitment to sustainability position it as the better performer over the 3-year period. While Woolworths Group exhibited strength and profitability, its liquidity challenges in certain years created contrast. Thank you.